Welcome to Your Number Man, where we share financial strategies, business insights, and inspiring stories to help you navigate a successful business. I am your host, Johan Zanik, and my goal is to help you achieve a bigger life in business. Today, we've got a very nice guy, a very dear friend of mine. His name is Brad Reynolds. We've known each other since 2016-17. He's a tax accountant, specializes in business structuring, taxing and GST, and all those nitty-gritty that's so essential for every business. He's a CPA and he started his career in public accounting practices in 1987. 10 years later, he started his own practice called Morgan and Reynolds. Now, his firm became a very key advisor in the business-to-business program for the Regional Development Australia here in the Barossa. And their part in the program was to provide businesses advice to existing and startup businesses. So in 2022, Morgan Reynolds was sold to Darcy Accounting and Tax. Brad is still with them today as a senior accountant and specializes in tax planning, business structuring, and financial consulting. So, without any further ado, Brad, welcome, mate. Welcome on the other side. We're on Zoom. Brad is down in Stratham. I'm here in Gawler. Brad, welcome to the show, mate.
G'day, Johan. Thank you. It's an absolute pleasure to be here. I'm looking forward to it.
Yes, great. I don't think today is going to be a problem for you because you're quite an expert on the mic and on radio. You've been part of the Barossa community radio for a few years and you had a very nice business show on there as well. Can you tell us a little bit more about that?
Indeed, I did. In fact, Triple BFM is the local community radio station there, and they started back in 1997. And when they went from just playing on weekends to playing during the week as well, I actually had a show there, which I ran for a couple of years until GST took over my life. And then I took a bit of a break. And then back in the mid-20-teens, I can't remember exactly when, but partner Nikki and I started up another show, and we ran that for a couple of years called For Buck's Sake. And look, we had an absolute ball. It was good fun. Once again, we focused on businesses. We had lawyers and we had politicians on, and always kept a bit of a business focus on the whole thing. We just ran out of time. We just didn't have time to do that sort of thing.
Yeah, I remember that was at a time that I've met you because I've knocked on your door back in 2016 or 2017 and I was looking for an office space in Tanunda and you and Nikki were quite busy with the radio show. It took a lot of time. Your program was a couple of hours, but it was a lot of planning.
It's generally considered that for every hour that you have on air, you do another hour of planning. Yeah. So you have a 2-hour show. So there's 4 hours, but we used to spend quite a bit of time. She used to like to get the music to match the guest.
Yes.
And so she'd try fairly hard to. Her knowledge of music is quite broad.
I remember it quite well. I remember a show one morning and you say, well, this is to our new tenant, Johan, who was also a money man, and you played my favorite Dire Straits, Money for Nothing.
There you go.
Yeah, that was great. Anyway, so let's get into business. So, Brad, you are obviously known for your expertise in advising business owners on the right business structures. Now, there are a few, and I know for the sake of my listeners who are small to medium-sized businesses, in your view, what are the most popular and what are the most secure and efficient kind of business structures that you can actually start your business?
There are really 4 main types of business structure. The obvious one and the easiest, quickest, simplest one is the old sole trader, where you've just got a single person and they run their business.
Yes.
And it's easy to set up. People get it. They understand it. And it's easier to close down should the time come to close it down. The risk of that is that it means that everything's on the line. So you're putting your house on the line and everything else that you own when you run that business because you have unlimited liability.
Yes.
So that can be a bit of a risk, and there are options available, which we'll get to in a moment. But that's the first one, quick and easy. Everyone can do it. The second type is a partnership, which is essentially a whole lot of sole traders coming together and forming a single business and going off into business together. Like the sole trader, you have the issue of unlimited liability, but you also have the issue that you, as a partner, what they call joint and severally liable for the debts. Let's say you've got two people and they're in business together, then that might be a 50% partnership. And that's fine. And so you might go, oh, well, I only owe, half of this debt. But in fact, you actually owe all of it. So you can be jointly held for it. So you can just say, I have 50% of it, but also severally, which means that someone can go for you for the entire amount.
Ah.
And the risk there is then that the other partner could get you into substantial debt. And if the other partner doesn't have as many assets as you have, then you could be forced to cough up the entirety of the debt or the balance of the debt, as the case may be.
So what is the advantage? Let's say you and me starting a shoe business together, Brad, and we decide we're 50-50 in a partnership, and you decide you're going to run the coop and you're going to start a banana farm back in the Gold Coast and just leave everything. So it means I'm going to be stuck with all that debt.
That's potentially true.
Yeah.
However, what I'd also suggest is, as you and I are not related to each other, that we would probably have a partnership agreement. And that partnership agreement would set out how we are going to operate the partnership. And if for any reason we separate, and whether that's because one of us has died or whether because we've decided that it's no good anymore, or one of us is incapacitated and not able to speak for ourselves, then the agreement actually comes into play. So then the agreement says that one person is going to pay out the other, or we're going to wind it up, and here's how we're going to value everything. So it's a bit of a prenup, I suppose, because really a partnership is, in many ways, it's a business marriage.
But the advantage is it's simple, it's easy to run.
Absolutely.
Yeah.
And look, each state has a partnership act, and that act does cover you for some things, but it doesn't cover you for everything. There's also a whole lot of case law that covers partnership law. But ultimately, I always say to people, look, if you're going to go into business with someone who's not your matrimonial partner or your de facto partner, then get some sort of agreement in place. If you go into business with your matrimonial partner and you break up, then in fact, family law usurps the partnership law. And the reason for that is that family law is a national law, whereas partnership law is a state law.
Oh, okay. Well, that's interesting. And then the one that's most popular and the best way probably for small business owners, if you want to attract shareholders at a later stage, what would that be?
Well, yeah, that's the next stage to incorporate and become a company. And a sole trader can become a company. Some have suggested that doesn't give you the protection that maybe you'd like. I liken it to a bit like a bulletproof vest, where if you're wearing a bulletproof vest and you get shot and you get knocked to the ground and it really hurts, but you get up and you can keep going. But if you do something really stupid while still wearing a bulletproof vest, you can still die. And so it is with a company. If you do something really dumb and you've got a company, you can still go broke. So you just need to make sure that you work within the rules of a company. But the beauty of a company is that it provides more asset protection. And so rather than you having that unlimited liability, you now have limited liability, which is what the limited in proprietary limited means.
PTY limited, yes.
So then you are only limited by the value of the shares that you hold. However, the company is limited to the assets that it holds. So if the company has $1 million in the bank, then that can potentially be lost too.
Okay.
If you have more than one person involved, then you can have a company with multiple shareholders and multiple directors. So then you become essentially a partner in a company. Once again, I would still recommend that you have some sort of agreement in place before you start.
No, of course, that makes sense. So it's all about security, and you've got a good structure through a P2R Limited, but it's also costing you a little bit more because every year you've got to register.
That's it. A company is a separate legal entity, and so yes, you do have to pay to get it set up. You can be paying, $1,500, $2,000 to set a company up, depending on how you want to get it going.
Yes.
And then you have the responsibility of a separate tax return for that company, and the annual fee, as you were just alluding to, the Australian Securities and Investments Commission, which I think it's about $350, $330 at the moment.
Okay.
So that's an annual fee that you have to pay just for the privilege of holding that company. Even if you don't do anything with it, you still have to pay that annual fee. And just going back to partnerships as well, a partnership has to do its own tax return, And so you need to be aware that there's an extra cost there in running that partnership.
So partnership has to do a tax return for the partnership itself, but you also
Correct, yes.
So it's not like a sole owner where you only do your tax as part of your personal income.
Yeah, that's right. And let's just cover that quickly. So if you're a sole trader,
Yes.
then whatever profit you make on that business, you have to include that in your tax return. It doesn't matter whether you decide that you're not going to draw any money out of that business. It's your business. You must include the profit in your tax return. At the same time, if it makes a loss, then that loss gets included in your tax return as well. So if you have other income from other sources, it all gets mashed together into that one tax return. If you have a partnership, then the partnership does its own tax return, and there's a share of profit, and each of the partners then includes that share of profit in their personal tax return. It's important to remember that even if you don't take any money out of that partnership, if the partnership's made a profit, you still get your share of that profit, and you still have to include it in your tax return. So you might go, look, things made $1 million, I get $500,000 out of it, but I decided not to take any cash out, or I only took enough to live on, 50 grand. The tax office says, too bad, you still have to pay tax on the whole $500,000. That's your share of the profit. Similarly, if you took $1 million out, but you've only made a $500,000 profit, you only pay tax on that $500,000. So it's what the profit says that you have to pay tax on. The company is a separate legal entity. It makes a profit. Profit belongs to the company. And so the company pays its own tax at 25 cents on the dollar.
Yes.
For most companies. And it belongs to the company. And if you want to get that money out of the company, then there's really only two options. Either you take a wage and you pay tax on that wage, as you would with any wage, or the company makes a profit and declares a dividend out of that profit to the shareholders.
And that dividend will be deemed as part of your income.
Then there is one final entity,
of course,
and that's a trust. Trusts are quite complicated. There are a lot more rules and regulations and things that you need to be aware of with trusts. So I won't go into it here other than to say that if a trust makes a profit, that profit must be distributed to somebody. It can't be held in the trust. So it has to be distributed to the beneficiaries of that trust.
Yeah.
The other thing to remember too, if something happens, if you die and you've got your business in a trust, that trust is not part of your estate because you're only a beneficiary. I have seen it cause problems in deceased estates because they've said, oh, look, I want to leave all of this to these people, but you can't because you don't actually own it. The trust owns it. So it gets really complicated really quickly. Speak to a financial advisor about that or to a tax accountant. You get too involved in those. In fact, maybe we should say now that this is all general advice and you need to speak to a proper...
That's right. And I can understand it takes a little bit of time to get your head around because a lot of people come to me, I'll just put my business in a trust name and then I don't have to pay any tax. But it's not as simple as that. There's a lot of permutations to a trust.
But it's also the same with a company. People think that they can just, we'll just leave it in the company and we'll just pay 25 cents tax. You go, yep, fine, that's absolutely correct.
Yes.
But you need to live. You're making all this money. You want to be able to enjoy it. How are you going to enjoy it? You have to get it out of the company.
That's right.
And once you get it out of the company, it becomes income in your hands, and then you pay tax on it at your rate.
That makes perfect sense. I mean, it also takes a bit of time to get your head around it as a sole owner as well. But I guess, like you said, if people start their own business, then they will have to go and perhaps just speak to an accountant, perhaps help them structure the business out for them as well.
Absolutely. Because look, the other thing that can happen is that you have some combination of those four. You can have companies in partnership, or you can have a company with a trust. Some people will hold expensive assets in a trust, say, for example, real estate.
Yes. And
we should probably just throw in there superannuation funds as well. Superannuation funds are a form of trust. You wouldn't normally, in fact, it's very much advisable not to operate a business through a superannuation fund, but you could hold some assets in a super fund. But
let's not go there today. Let's talk a little bit about GST, Brad, because you got a lot of extensive experience with it. one of your contracts you had was with the government to go and train people about GST and the new rollout. You're pretty much a GST whisperer, if I can put it that way, because you were involved with specifically farmers, wasn't it?
Yes, the
Paint
Farmers
farmers.
Federation had a contract with the government, and
Yeah.
then I worked with the Farmers Federation. And look, that was good fun. We travelled the state,
Yeah.
having a look at running seminars for farmers on how it was going to impact them. In fact, I even had an invitation from the Federal Treasurer to meet him in Melbourne. But unfortunately, I was so stupidly busy with the whole GST starting up that I just simply didn't have the time to go. Certainly quite the honour to be asked, but I didn't get the chance. The big thing is the registration. So your turnover, your sales, not your profit, but your sales are $75,000 or more, then you must be registered for GST. If you are a taxi driver or a ride share, like Uber or something, then you actually have to do it from the first dollar.
All right.
So if you're a taxi driver, you must be registered for GST no matter what your turnover is. If you're a not-for-profit, then that is actually $150,000. And the $75,000 is calculated from any 12-month period going backwards and also going forwards. So some people go, oh, look, we're in July now, and it looks like my business is going to be turning over $75,000 in the next 12 months. So I have to register, even though I've only just started now and I haven't turned over $75,000 yet. I'm pretty certain that before the end of the next 12 months, I'm going to be hitting the $75,000 mark. So therefore, I have to be registered.
Okay.
You can't keep looking back and going, oh, I haven't got to 75 yet. I haven't got to 75 yet. You've got to look forward as well.
And some of the other pitfalls is people aren't always sure what can they claim on GST and what can't they claim on GST. You probably need to go and see an accountant as well just to make sure that you got your setup correct.
Well, absolutely, because not everything has GST on it.
Yeah, you've got to be very careful with GST. But let's talk about tax in specifically. Now, the way I explain to people, I'm an accountant. I'm a management accountant, costing accountant. My job is to work on your efficiencies, work on your costing, do a bit of forecasting. And it sounds a little bit weird, but I'm actually here to help people pay more tax. Where a person like you, on the other side, it's your job to make sure you're maximizing the tax cuts in a legal way.
Yeah, look, my philosophy is that income tax or any sort of tax is an expense. And therefore, like any expense in your business, you minimize that expense. But ultimately, you go, hey, look, you're going to have to pay some tax.
Yeah.
You'll always have the expense. So, yeah, by all means, let's minimize it. Let's try and maximize the amount of money that you have at the end of the day.
Yeah. And what are the most common pitfalls?
Actually, a couple of ones that are coming up is the asset purchase, where people talk about the $20,000 tax write-off.
Yes.
And it's actually not a $20,000 tax write-off. It's a $19,999.99 tax write-off. If you buy something for $20,000, you have to depreciate it. So it's less than $20,000. So what happens there is you might buy an asset that you're going to use, and it's a less than $20,000 van. Then so long as it's less than $20,000, then you can claim that. If you're registered for GST, then it actually becomes $21,999. And then you take the GST off, and that brings you down below the $20,000 mark, and then you can write it off.
So I can write off that van one shot at this stage?
Yes, if it's less than $20,000. Now, the important thing to remember too, that it's the gross price of that van.
Yes.
So if you bought a $35,000 van, but you traded in your old van for $15,001, so that the changeover price is $19,999, you can't do that. You have to depreciate that $35,000 van. There's two transactions. There's the purchase of the new van for $35,000, and there's the sale of the old van for $15,000. So those two, they're separate things. And that's often a trap that people fall into. They go, oh, look, I only paid, $15,000. And you go, no, you didn't. You actually paid more than $20,000. So therefore you can't claim it. You can't write it off.
Okay.
The other thing to keep in mind, just talking about that trade-in, is that's a sale. And if you're registered for GST, then you have to charge GST on that sale. So if you've been given $15,001, like I use as the example, then 1/11 of that is actually GST if you're registered for GST. So you need to remember that, and you need to include that in your BAS when you go to do your BAS at the end of the quarter and report on your GST sales.
Yeah.
Another trap is motor vehicles and private use. A couple of quick stories about the tax office
Yes.
and auditors. What they've been doing is they've been going to like football games. So you get an AFL match down at Adelaide Oval, and the tax office will send their auditors and they will take photographs of every single car registration in that car park, and then they'll go back and they'll plug it into the database and they'll see whether any of those vehicles are registered as business vehicles, and particularly if they're registered in the name of a company, then they can go, oh, all right, so we saw your vehicle at the AFL footy match on Saturday, so that's private use, and you're claiming this vehicle 100% business use. So we think that there's a fringe benefit here. You're not entitled to claim 100% for the vehicle, and then you need to prove otherwise. The other thing that they've been doing, they went to the ferry at Fraser Island in Queensland.
Mm.
And Fraser Island, for those that don't know, is a bit of a mecca for four-wheel drive enthusiasts. Often on the weekend, the ferry would have a whole lot of four-wheel drives heading off over to Fraser Island for the weekend. The tax office was there with their auditors, taking photos of all the vehicles, and all the tradies have got their four-wheel drives, and they're towing their van, and they've got the fishing rods on top, and they've got ABC Plumbing written across the side or something like that.
Yes.
And then the tax office has come along on Monday morning and contacted these people and said, we think that you're using this for private use. That's the extent that the tax office will go to.
Yeah.
So just be careful. The other thing is, the police have car registration recognition cameras. They're working in cahoots with the tax office, and the tax office is getting that information. And they're going, oh, your vehicle was used on Saturday night.
Well, that's interesting. I've actually never knew. I've heard about, let's call it ATO spice, but I don't know. That is actually that they go so far as to go to the footy or on a ferry.
They are actual things that have actually happened. So, just be aware of that.
Okay, well, yeah, we've got to be careful, and you've got to make sure that we claim the right thing. That's important. There's great stuff on the market today. If I want to start a business, I've already got a business, and I want to get a good system. We're talking about bookkeeping software like Xero, Recon, MYOB, Intuit. And I know your business is quite specialized in Xero, isn't it?
Yes, it is. That's my preferred one.
Your preferred one, yeah.
Like all of them, it has its good and bad points. It's not very good at stock control. So if you have a lot of stock, then the beauty of Xero is that you can plug in other apps and other programs to it. So it's hopeless at stock control. Don't even waste your time trying to deal with stock in Xero. It just won't handle it. You can plug in programs to it. And in fact, often some suppliers, I've got a plumber, for example, and they normally get supplied through, I think it's Reese, but I'm not sure. And they've got a stock control program that plugs straight into Xero. So then they just buy all their products through there, and it automatically updates everything Xero. MYOB is much better at stock control, but I've had problems with MYOB.
Yeah.
Look, I've had problems with all of them, to be honest. Once again, what's going to work for you?
Yes.
And just be prepared that you might have to buy other little apps that plug in to whatever it is that you buy in order to actually get things to work a bit more efficiently for you. If you have staff, you're going to have some sort of electronic reporting of wages, because that's how the tax office works now. There's no way around that.
Yes, if you've got staff, yes.
It's called single touch payroll.
Yeah.
You need to have single touch payroll. There's no way around that.
Okay.
Also, if you register for GST, it's so much easier to do it with a program.
Yeah.
Just don't waste your time. Spend the money and just consider a cost of business that you're going to have some sort of accounting package.
Yeah. Somehow it makes your life a little bit easier, because you're not going to have to deal with all the nitty and gritty of your clients.
Every time you enter a transaction into the accounting package, it updates what it is that you owe to the tax office. And then at the end of the quarter, you do a report, you just check it. It's fairly straightforward.
Yeah.
Which is why I recommend, look, by all means, do it yourself, but get it set up by someone that knows what they're doing. Pay somebody to get it sorted first.
Yeah.
Then once you're comfortable with it, then tick along with it. I've got clients that do their own, and if they have an unusual transaction, they'll give me a call.
That's right. No, that's the easiest. Like I say, perhaps it might take a little bit of work away from us as accountants or bookkeepers, but it frees up our time to spend more time in analyzing and do better tax planning and better strategical as well.
Yeah, exactly. Yeah.
Yes. Now, Brad, we've gone through a few things. I did mention in the beginning, I know you've done so much in your life, but one of the things was you built up a very successful accounting practice in the Barossa, Morgan Reynolds, and then you sold it last year, or no, 2 years ago, to Darcy Accounting. I guess that was quite a big thumbs up moment for you in your life, wasn't it? But how did you navigate it all? I always tell people, a lot of people would say, well, what if I can sell my business in 2 or 3 years' time? I say that's great because you've got to start your business with an end in sight. But it is quite daunting. Do you mind telling us a little bit about your experience of selling a business? How hard is it or how easy can it be?
Look, getting into business is a bit like never get into something without knowing how you're going to get out. Always have an exit strategy before you start. Okay. And that's what I had as well. My plan was always to build it up to a point and then see if we can offer it. But of course, the climate changes, the whole accounting industry changed over time. But look, I was lucky in that I was able to find someone that got on really well. We still get on really well. And just said, look, rather than me working for you part-time and working for me part-time, what if I just work for you full-time and you buy my business? So that's what he did. And I was able to take advantage of some small business capital gains concessions because I'd owned the business for more than 15 years. Okay. But the sale was free of capital gains tax.
Good on you. Wow.
So there are 4 different capital gains concessions that small businesses are entitled to have a look at. The first one is a 15-year exemption. If you've owned your business for more than 15 years and you meet the conditions of being a small business, then you're in. You don't have to pay tax on the gain no matter what the size of that gain is, so long as, once again, you meet the small business conditions. If you haven't held it for 15 years, then you go to the next step, which is when you have a capital gain, you only pay tax on half the gain. But if it's a business asset, then you actually get an extra 50% discount. So then it becomes only a 25%
wow.
gain that you pay tax on. And it's the gain. So you're only paying tax on a quarter of the gain instead of a half of it.
Yeah.
That's the second option. And then the third option, or the third step, because you can actually add these together.
Yeah.
The third step then is that there's a retirement exemption of $500,000 over your lifetime. And if you think about it, if that's on a quarter, so in fact you can actually make a gain of $2 million over your life on the sale of business assets and the business and not pay any tax on it.
That's not bad, yeah.
And that's the gain. That's not the sale price. That's the gain. So that in itself, it's pretty unlikely that a small business is going to make those sorts of profits. The fourth option is the small business rollover. So you can get your gain. You might have a shop and you sell that shop and you make a gain on that shop. But you go, but I still want to be in business. I still want to keep going. So then you can go, all right, I'm going to go buy a shop somewhere else. So then you can roll over the gain that you've made in that first shop, not pay tax on it now, as long as you apply that gain to the second shop. Or to the new shop or the new business that you buy. You might even sort of go, okay, I've got business A, I sell business A, and I'm going to go off and do a brand new business. So I buy a brand new business that has nothing to do with the old one. And so you can roll over the gain that you've made in business A and apply it to the cost of business B.
I get it.
And then, look, if you're under 55, then that gain would have to be rolled over into superannuation. If at the end of it there's still something left, if you're under 55, then you actually have to put that into a superannuation fund.
Okay.
Otherwise, you'll pay tax on it.
So that's great. So what we got to remember is, capital gains is not as monster as everybody think. I mean, okay, I've heard a lot of people bought property and sold property and then had to pay a lot of capital gains, but there is ways that you can minimize it.
So long as those assets that you're selling are business assets, so they have to be able to meet the condition of business assets. And once again, that can get tricky, but that's something to ask your accountant once again.
Yeah, not a disclaimer. People, make sure you ask your accountant. Brad is a guru of all this stuff, but don't take his advice. Just double check it with your personal accountant as well. So, Brad, you're an accountant. You work very hard. You sold the business. You still got a nice little property down south, which you sort of like manage on the side. But then you've also got a deep interest in aviation. You've got a military history. You're a volunteer firefighter. You're still with the CFS. You've been involved with community organization. And then also, a very big shout out to Justin Stein and his team at Balloon Adventures in the Barossa, where you've had quite a big involvement over the last few years there. How did you manage all this stuff? And also, is there a bit of a cheat sheet that you can give to our audience here? Like, what can you do to manage your time better, to make sure you can have a successful business, but also do what you want to do?
Learn how to say no.
Ah, good.
It's as easy as that.
Yeah.
Look, as a volunteer firefighter, we get a pager message. Actually, these days it's on the phone. And I'll look at it and I'll go, that's probably going to be an hour. I can afford an hour at the moment. Or else you might look at it and go, oh, actually, that's a big job. It's going to take, half the night or whatever it might be. And you sort of just have to go, I can't go. I can't do that one. Same with business. A client might go, hey, listen, on Wednesday, after we finish, I might get a message from someone saying, can you have this done by Friday? And I'll just look at my commitments and go, no.
Yeah.
But plenty of people will go, yeah, I can do that. And then nothing happens. They just
learn to say no.
They just get crushed.
That's great.
So learn how to say no. And look, Barossa Balloon Adventures, I absolutely adored that job. It was the most fun job I've ever had in my entire life. But even then, there were times when I'd just have to say, oh, Justin, I can't work this weekend because I've got commitments with something else.
Yeah.
And that you just have to be able to say no.
No, that's great. Great advice, Brad. Thanks for putting your time aside on the great Fleur Peninsula. And, you're out there in beautiful Strathalbyn, close to Strathalbyn anyway. Thanks for your insights, your great conversations. And I know sometimes it's a little bit of a boring subject talking about numbers and tax specific, but I think we've made it quite interesting with all your little stories. So thanks for your time. Really appreciate it.
Thanks, Johan. Look, it's been an absolute pleasure. I certainly appreciate the opportunity, and I'll look forward to hearing the final result in due course.
Yeah, definitely. We might even get you back at some stage and talk a bit more about the daunting capital gain stuff.
Yes, we've left some doors open there, haven't we?
Yeah, definitely. All right, people, that's a wrap. 2 big takeaways today is make sure you got your tax in order. Go and see a professional if you're not sure. And learn to say no. Cheers, Brad. Mate,
thanks.
Thanks. Well, thanks for listening to the show. I really hope you got some great takeaways from it. If you found this episode helpful, please subscribe to the show. It would be great if you can share it. You can also look me up on socials. I'm on Facebook, Instagram, LinkedIn. And you can also get in touch with me on my website, which is www.yournumberman.com.au. And you can get in touch with me as well. I'll definitely get back to you. See you next time. Cheers.